Good morning, everyone, and welcome to this fantastic webinar that we're all excited about on this Thursday morning. My name is The Finance Ghost, a voice you'll hopefully recognize from a podcast or two. I won't be turning my camera on today. I hope that's not the only reason you joined. Sorry to disappoint you straight up front, but luckily there's lots of other cool stuff to be here for other than that. So, this is the team that keeps us up to date in Ghost Mail every day. If you've been reading Ghost Mail, you will definitely know the TreasuryONE name. And they've been doing a wonderful job of updating us on what's going on in the world of currencies, commodities, interest rates. I mean, it's been unbelievably volatile over the past couple of months. Last year, I think, was all about equities. And yes, of course, it was driven by macroeconomics. But over the past few months, equities have taken a hiding of note, as any of us with shares will attest to. And if you haven't been following the macroeconomics around that, you would be very confused as to why that is happening. So it's so important to get this overarching view of what is going on out there. And I'm certainly grateful to the team from TreasuryONE for bringing that to the Ghost Mail readers. And I know there are others here who didn't necessarily, get invited through Ghost Mail. So welcome to you. We hope you have a fantastic time on this webinar as well. So we've been hearing lots of terms like transitory, inflation, dollar-euro parity. That's come up in the last couple of weeks. The equity bull market is but a distant dream in 2021, that's for sure. And, if you're an investor, you need to know what's going on out there, as I've mentioned, and this webinar is certainly going to help with that. But also for business owners and corporate execs, which is really TreasuryONE's core business, any optimization of Forex rates that you can achieve, any improvement of the rates you can get on your cash that you can achieve, that makes all the difference in obviously difficult times where revenue growth might be tricky to come by. So I'm going to introduce Andre. If you want to flick to the next slide there, we can all see that very cool photo. There it is. So Andre is a currency risk strategist at TreasuryONE. You may be able to see Vichart on the call as well. He's the head of market risk there at TreasuryONE. I'm going to hand over to them now. I think Andre is going to take us through the presentation. Just two things. One, the YouTube recording will be available after this, so look out for that in case for any reason you need to drop off or load shedding hurts you or any of the other joys that we all deal with on a daily basis. And then the other point is that you will need to ask your questions in this chat box on the right hand side, please, and we will try and address as many of them as possible at the end. So without any more delays, let me hand over to Andre, and please enjoy.
Thank you very much, Mr. Finance Ghost. Welcome to everybody from my side. I'm going to try and make a little bit of sense. One of the words that was used by the Federal Reserve for quite a long time when they started speaking about inflation was transitory. And at one stage I joked and said, yeah, well, it reminds me of people sitting in a transit lounge at the airport, that if they stay there long enough, then they apply for political asylum in a country. Now, the inflation is certainly applied for political asylum in various countries, and it was granted. So how do we make sense out of all of this? We all know by now that yesterday the latest inflation rate was announced in the US. That was a bit of a shocker. And this morning we wake up with Canada already increasing interest rates, Philippines increasing interest rates, Singapore increasing interest rates, all sort of not even on scheduled meetings, just spur of the moment, and all following up on the figures yesterday. So I'm going to start the slideshow, and then if we go back, then, it all started in 2020, end of 2019, beginning of 2020, when we had COVID hitting the shores. And that was countries being brought to standstill. They were in lockdowns for long periods of time. It came and went. Europe was specifically very badly hit. If we go back and we think about France and we think about Italy, they were very badly hit. So was Britain. But I think one of the problems there was that it was a new thing. It was something that hit the world the first time since 1918, when you had the flu pandemic. And I think the leaders throughout the world didn't really know how to react and what to do. And it was sort of a trial and error. And we had volatile movements on the South African rand, for instance. We had seen that it turned around the 19 levels. And at that stage, everybody was thinking that it might be going to 20 and 21. So it was not just a pandemic, it was a crisis for the world in the sense that nobody really knew how to react. And with the lockdowns came all sorts of problems that happened throughout the world in terms of economics, because when you bring something to a standstill, then obviously your manufacturing industries, your export markets, everything just becomes a massive problem. In harbors, you had ships lining up that couldn't be offloaded because they couldn't enter harbors. Suddenly people started speaking about a shortage of containers. Now, what happened to the containers, for instance? Well, the containers didn't disappear. The turnaround time for them just became longer. So what took 6 weeks for a container to be back in production, if I can call it that one, was later 2 and 3 months before it could go on. And then we went on from one crisis to the other, just as we thought we kind of sorted out the COVID thing and it was dissipating into the background. We had Mr. Putin invading Ukraine with a war, and that brought another crisis, because suddenly we had a country with massive oil reserves and a very big contributor to the oil export market that sanctions was imposed on them. So we had the West saying that we will not really enter this war officially, but sometimes, I wonder if you say that we're not entering the war, but you impose sanctions very wildly on a country, then you are actually entering it. And then when you say to the other country, we will support you and send in massive amounts of weapons to assist you in your fight against your enemy, then I find it hard to believe that you can say that you're standing on the sides and that you have not entered it. Now, this crisis plays it out in Europe, and we'll get back to that a little bit later, but we know that there's a big dependence from Europe on Russian oil and Russian gas, and when sanctions gets imposed, then suddenly that gets cut off. But that's not the only thing that gets cut off. When you impose sanctions, and Russia is one of your biggest one of your big trading counterparts, then suddenly you find that you've produced goods that is not now being allowed to enter the Russian market because of the sanctions, which simply means that also in your own country, your exports will be dwindling. That will have an impact on your manufacturing side, etc., etc., etc. So Europe very specifically targeted on that one. When you take COVID and when you take the Russian-Ukraine war, and you think a little bit back and you go as way back as 28, when you had the financial crisis in the world, where central banks started printing money, then all of these things leads to another crisis, and that was the inflation crisis, because suddenly you had inflation on the rise with interest rates sitting very, very low, and inflation started concerning people, and that's when they said, it's transitory, it will go away, it will not be on a runaway train, and we will be able to contain it. We don't have to act that aggressively. And we all know at this stage what happened to that. But what contributed mostly to this is the damage that oil has done to this. And we can just look at that graph, and then we can see that fuel prices have risen more than threefold since the start of 2020. So in 2020, we know that suddenly we were not allowed to drive a lot because we were in lockdowns, and we were told when we can drive, and we couldn't cross provincial borders, etc., etc. So we had very little demand. That demand completely fell away in terms of oil because of what happened in the world. Not only had the private people consumed a lot less because they didn't go to offices, they couldn't go anywhere on leave or cross provincial borders, but it was the same very much for people all over the world. But also industries used a lot less oil because they produced a lot less, they needed a lot less, and the oil price just fell away. There was one stage, one day, that the oil price actually turned negative on a futures close. But we know that the oil price was trading around the $17 and $18 and $20. Looking at an oil price now that reached the peak of 125, and then in some cases we can almost be lucky that the fuel prices have only risen threefold since the start of 2020, because it could actually have been much worse. And this is something that's not only unique to South Africa, the fact that we have a fuel price of almost 30 rand a litre at this point in time. It's a universal thing. It's throughout the world that this is the case. And people can really get upset with it, and they can try and protest against it, that we're seeing in South Africa. But it's really beyond the control of anybody specific. It's problems in the world that needs to be sorted out. But that has got an impact. If you look at the oil price and you look at fuel prices going up, then that's got forms very much part of the inflation picture, because if your oil price goes up and your fuel prices goes up, then your shipping cost goes up. Your transport from one place to the other goes up significantly. And no company can just take all those increases and absorb it into their own cost structures. So they have to pass that on. And if they start passing that on, then that forms part of your inflation picture, because suddenly you have food prices going up. Well, prices of virtually anything that is being transported, imported or exported, just starts going up exponentially as this is happening. And that drives your inflation continuously up. Apart from that, you then have consumers, you have employers, and people being employed that says, I want more money because I can simply not afford living on the wage or the salary that I'm getting currently. Because of all these price increases, I need more money. So that also spins over into your salary cost, and your wage increases needs to keep up with inflation. Things that's not been budgeted for. If we just think in terms of the discussions going on currently in South Africa, we know that currently the negotiations with Eskom is around a 7% increase that's demanded. We know that at SARS there's problems because they want 7%. So it's just all over the place that these demands are coming. We know that the South African government is also in negotiations with their staff. They are also asking for somewhere in the order between 7 and 10%, with the government offering 2%. That simply doesn't have the finances to increase it. So we'll see where this one goes on that. But this all starts back from the crisis, as a COVID crisis, printing of money by central banks, and an oil crisis throughout the world that brings these things on. Logistics remain a problem. We know that China still has a zero COVID policy. They've been in some lockdowns just 6-8 weeks ago. They're still talking about possible lockdowns because of their zero COVID problem, and there's not zero cases. There's continuously this concern that China might go into lockdowns again. So your shipping costs, your container costs, your inventories, everything is on backlogs and on increases of prices. Because if you look at the backlog that, for instance, gets created, then if you think in terms of a trucking company that would take a truck from Joburg to Durban, and they would be able to do 10 trips on average per month, and suddenly, because it takes longer to get the things out through the harbor, it takes longer to offload, it takes longer for all these things, and then you still get problems on the N3 with protests, then suddenly they cannot do 10 trips or more, they can only do 7. And that means that they have to take their cost, their fixed cost, and that they could have taken over 10, now have to take it over 7, which means that forget about oil prices, forget about anything else, simply the longer turnaround time forces them to increase prices simply because they do less trips and they need to recover that cost. Then if you look at the expansion in global stimulus, and I've spoken about that, then we have seen since 2008, when the financial crisis started, you can see if you go and look at this graph there from 2008, prior to that, you had stimulus into the markets. But since 2008, you can see how massively it increased. And then in 2020, when COVID hit us, you can see how big the stimulus was that then came in. And it's only now that you see a slight turnaround. Now, we can expect that turnaround to happen a little bit faster because that was one of the big contributors. I mean, we all know what the economic textbook says. If the economic textbook says to us that if you print money, you will see inflation. I think one of the problems that happened throughout this expansion in global central bank stimulus was that a lot of that money was actually pushed into the markets, and the idea behind it was that it would find its way to consumers, and that consumers would be able to, in essence, go on a spending spree and keep economies going. But that's not really what happened. A lot of that money found its way into the hands of hedge funds and banks, and they actually just used that money to create a little bit of extra income for themselves. And although there was very low interest rates, some of that was given through to the consumers, but not all of the benefit of the low interest rates that was caused by this massive stimulus ended up in the hands of consumers, because there's your risk margins and your everything that banks add. So they didn't get all the benefit of that. So we are seeing that changing now, and I think that will continue with central banks buying back more of the paper that they pushed into the markets. So now what happens with all of this? And I came up with this little graph because on the bars we can see that we've had inflation on a runaway train. US came out yesterday at 9.1%, and I've got that little man there at the top now trying to pull the interest rates back up with him. But because you need the interest rates to follow inflation, because in essence, at the end of the day, you really need real positive interest rates if you really want to attract investment. But now for the first world countries, it's not that important to attract investment because they can just go in and borrow more. But for your emerging markets, it's important to keep inflation rates lower than what your interest rates are, because you need to attract investment into your country. But we can see clearly how inflation needs to follow interest rates going up. And hence, with inflation on the runaway train in a lot of countries, you need to start acting very fast on interest rates. The US yield curve is flashing danger signs for us at this stage. We have a 10-year yield sitting around the 2 and a bit percent with the 10-year yield around the 2 and a bit percent with 2-year yields around the 3%. So you can clearly see how it turns inverse, and that's flashing danger because that's not really sustainable on the long term. You need to turn that around, but to change that around is a problem that I think the Fed sits with and scratching their heads every day. Money supply is reversing. So as we see interest rates going up, money supply is turning down. Now, that's simply because people don't have money. The consumer, the man in the street, does not have money anymore. It's not just in South Africa, it's sort of throughout. Because as interest rates rise, people with debt, and I think If we go to the Americas, I think we'll find that their consumers has got quite a bit of debt. Their cost goes up. Their cost in terms of fuel and everything, food, everything goes up. So they have less and less and less money to spend. But they cannot go and borrow more because that's even costing them more, and they simply don't have the money. So consumers will turn around, and central banks will continue with their increase in interest rates and changing of money supply so that they can fight this inflation monster. If we look at this graph, then we can see clearly the Fed hiked 75 basis points at their last meeting. Very unusual. So if we go and look, then we can see there on the graph on the left-hand side that 100 basis points over the number of years, that how few 100 basis points and 75 basis points moves there was, but how many 25 basis points move there was. So the 75 basis point hike at the previous meeting was a very unusual one. So the question is, will they continue on this trajectory of 75 basis points, or might it now jump to 100 basis points, especially after yesterday's 1%, 9.1% inflation figure? Because you really need to aggressively attack this monster of inflation before it gets even worse and unstoppable. That's not something that anybody wants, because if you think in terms of the 9.1% and the targeted inflation rate of the US, for instance, their targeted rate is 2%. Now, 9.1%, 2% target rate, they have a heck of a fight on their hands to get this thing back. But you have to take a lot of other circumstances into account, because this discussion this morning contains one of that very nice concerning words called recession. So if you look at what's happening in the US already, then you already see that expectations is deteriorating. If you look at the business and households, they have no choice to turn because of the weaker disposable income for people. And here's the problem. The key drivers of inflation does not come from demand by consumers. It's cost pressure, inflation driven. So yes, you can increase interest rates, but can you really stop the inflation pressures because of a situation in Ukraine and Russia and oil? Because that's really where it comes from. Can you really change the inflation if there's a continuous problem in terms of your logistics side and cost pressures coming from there? Can you really, with inflation rate, with interest rates, change the cost pressure, inflation stopping, people asking for higher wages? So it's a bit of a problem for the US. You have to do something, but is it really effective? And already you're seeing a decline, as I say, in the economic expectations. If you look at their credit impulse responding to inflation and rate hikes, then also there you can see that already that's also responding. You can already see that there's a weaker demand, and that's because of weaker growth. And being at a consumer, being at a major corporate, everybody's concerned to go and spend money now. They'd rather sit on their cash, they'd rather not spend, they'd rather not expand, so they'd rather not go and borrow money at these high rates because it's expensive. So there you can see it clearly on the graphs that we've already have the response to that. Economic surprise indices of the US is plummeting. China is recovering a little. Now the recovery in China, we can sort of go question mark, question mark, question mark. Will that continue? Because if they have the zero policy and they go into lockdowns again or anything like that, then also that might plummet and also that might go down. So clearly we can see that in terms of economic throughout the world, things are not looking very happy. The best of the recovery is behind us. Momentum is waning, and we can clearly see that. Developed markets, the world, the European Union, China, all of them on the downturn, where we see clearly that economies is not on the up, it's on the down. Then we get to commodity prices, and here we can clearly see, we know, we've seen it, our commodity prices is retreating. Now the commodity prices to me was an interesting one, because when you go back to 2020, suddenly you had commodity prices after, as we came out of lockdowns, you had commodity prices on a massive increase. That massive increase was because demand started coming back, people started working again, etc. And we had these massive increases. We can see the spikes there. And then other things hit the markets again, and then commodity price retreated quite aggressively as world economic growth is coming in for problems, and was downgraded several times by everybody. The reserves in gas and petroleum leaves the European Union in a very, very bad position. It's not easy to find alternative markets that easy. And because of the Russian situation, that oil doesn't have it. They sell less and less oil, so the supply side is a problem, and Europe specifically very dependent on the Russian side. So Europe is in a very, very difficult position. They have rising inflation, they have interest rates, and they've not started moving anywhere on interest rates at all. They're still in negative territory with inflation on a runaway, still very dependent on what happens in Russia and Europe. And I think the people in Europe is very, very concerned and very much in a difficult position. We've seen how other countries had started joining NATO. We've seen how the US had said that they will increase their presence in the European Union from a military side. So I think Europe, not just because of gas and oil, but because of the whole Russian-Ukraine situation and their closeness to this, and the possibility, if this war expands, that it would be expanding into Europe, is making the Europeans extremely nervous. And with an economy that's already in a very bad position, and inflation on a runaway train, it leaves them very little room to move. So the euro definitely in for more problems. The dollar, if we look at the dollar, then it's a very expensive currency at the moment. It's not an expensive currency against the South African rand. It's an expensive currency against the euro. It's against the pound. It's against all major currencies. No, it's against all currencies that it's expensive. The dollar index is trading at very, very high levels. And when we did the slide presentation, it sort of just said dollar exchange expensive, but more to go, point. And I said, just add the question marks, because is there more to go on the dollar, or are we maybe reaching turning points? Well, that's a very big question. But what we do know at this point in time is that it's very expensive. If we turn a little bit local, then Eskom is still a problem for South Africa. Stage 6, stage 4, stage 5. I mean, I have to wake up every morning and see what stage we're at, and at what time are we changing what stages. Nobody knows anymore. We're all in the dark. We're all spending fortunes on getting UPSs to be able to run. But it's a massive problem for business. We're losing billions of rands a day. We're taking percentages points off our possible growth that we could have, and we're making it extremely difficult for every industry and every consumer in this country. Our terms of trade are now neutral as oil surges. Now, terms of trade, that refers to imports and exports, and it was very positive because our exports was way above our imports, especially when the oil price was this low. But with the oil price up at the levels we are now, and us fairly dependent and, well, totally dependent on imported oil, our terms of trade have changed and are now neutral. petrol, diesel versus Brent and Brent oil. There we can see the massive increases and where it's going. And we know what the impact is. We've discussed that now, the impact of that on inflation. So if we look, if we look at our inflation versus the diesel price, then we can clearly see as the diesel price goes up, the inflation goes up. And our inflation also now pushing above the 6% target band. So we're outside the target band of the South African Reserve Bank. And we will most probably look at them increasing interest rates again at the next meeting. My expectation would be that it would be 50 basis points. But with the inflation figures coming out yesterday in the US and the possibility of them moving more, as they can move more, the possibility of us also moving more also becomes an increased possibility. We have the advantage that we are slightly ahead of the curve because we started our increases a little bit before the US started that, but we also know that South Africa is more dependent on keeping our interest rates at relatively high levels because we need money flowing into the country rather than money flowing out of the country. So we need to keep our interest rates attractive to keep the carry trade attractive. The rand is still undervalued, but these graphs, when you speak about an undervaluation of a country, currency is always interesting because to say that it's undervalued simply says that it could move closer to the zero line and work around the zero line. But these periods can sometimes be for very long, that it's either in an overvalued situation or in an undervalued situation. It does not say that it needs to happen tomorrow. Now, having said all of that and looking at the world, we can see clearly that the chances of Europe going into recession and what we've spoken about, their dependence, where their interest rates are, where their growth are, etc., they more likely to move into recession as the first part of the world that moves into recession. Unfortunately, this world is very, very interlinked with each other. So if they go into recession, it's got an impact on China. If it's got an impact on China, it's got an impact on America. If that's an impact on all of those, it's got an impact on us. So it will have an impact on world growth, and the chances for countries going into recession is on the increase. None of them are currently in recession, but the chances of going into recession is very, very likely. I would place the chances of Europe going into recession 80% and above, and I would place the chances for the US going into recession at 60 to 70% going forward. And they will continue on their path of interest rate increases aggressively, and that will push them closer to those levels. Having said all of that, it puts us into a situation of depression. So we're not heading for economic depression, but it puts us in a position of economic depression because we have to try and make sense out of all of this going forward. And the easiest one that I've said the other day, if you look at the world and you look at everything that happens, then we can look at graphs. We can pull up as many graphs as we want to, and we can think about it any way we want to. But it's simply, if we feel uneasy about COVID and we're not really sure what happens in the world because of that, then we buy dollars. And if we then see the Russian-Ukraine situation, and we don't know where the world's going, and we don't know where the war's going, and we thought it might be 3 weeks, and now it's 3 months, and then it becomes 6 months, then we're uneasy. Then we buy dollars. And we look at commodity prices, and we look at inflation, and we look at interest rates, and we look at the uncertainty of where world growth could be and what could happen, and we feel negative about all of this, then we buy dollars. the advantage is currently, if you go 2 years back and a year back, you bought the dollars, but you didn't earn anything on it. It was actually zero interest rates. At least now, there's even a compelling reason why you can be buying dollars. You earn interest on it, and you're likely to earn more interest as the Federal Reserve increase their interest rates. So for as long as we have this uncertainty with us, and we don't really know where things are going, I think this whole thing of I'm buying dollars will continue, because we need a little bit more certainty. So it's almost will be good if we go into recession. It will be good fantastic if we get some solving of a problem in Russia and Ukraine. There's also some other things that I do know is if we go into recession, then there will be less of demand for oil. Then the prices of oil will come down. And if that all starts coming down, the cycle will change. That I know for certain, that the world's economic changes constantly, but it works in cycles. And we are in a down cycle. But following this down cycle will be an up cycle. But we'll still have this volatility for us for a while. Dollar will still be the favor of the markets for a while, and people will still feel uncertain. The rand will still be vulnerable, but we at least have one small little advantage at this point in time. We are in the middle of the month, and at the middle of this month, we have an oil price that's declined slightly. Yes, the rand weakened, but if you look at our fuel prices, then we are in an over recovery situation. So likelihood is that we'll pass the end of July, beginning of August, without a fuel price increase if all things remain stable. And if these things can continue for a while, staying stable, then we might see a change to the cost pressures for inflation. And if we see that dwindling, then we could be closer and getting closer to a turning point. So not all doom and gloom. I think there is some light at the end of the tunnel. Any questions from your side, I will gladly take.
Thanks for that, Andre. Finance guys, I'm just going to jump in here. We've got a few questions here. So I'm going to start with Craig. It says the Fed is stuck and we will increase interest rate, the markets will crash, Fed will help again. Yes, Craig, at the moment, if you look at, quite interesting is, I looked at it this morning before the presentation. So at the moment, the Fed is definitely, they're aggressively pricing for hikes, and they're even pricing as much as an 80% chance of 100 basis points hike for the US in July. But the interesting fact is they're already pricing the rate cut in the US as soon as January 2023 by 25 basis points. So definitely the market is aggressively pricing hikes, and they want to push the hikes, but the market's pricing cuts as well. So we just need the Fed to pivot a little bit and see when they're going to start cutting, and then probably, like Andre said, we'll see the economy and stuff turning. Andre, one for you is Pete asked about trade unions demanding unrealistic wages that the industry can't afford. Would you please comment on the hypothesis that trade unions represent a minority group are a major contributing factor to both inflation and unemployment? Do you want to take that? And then he's added to his other question.
Yes.
We're interested in your views on trade unions as being a handbrake economic growth. Also, they still have a role in the free market economy. The cost of strikes of both employees and employers are prohibitive the economy going forward. So, yeah.
Yeah, I'm having a smile on my face because, we have a massive problem. We avoid saying things in this country. If we go and look at what the trade unions did, and we look at the negotiations with Eskom regarding wage increases, and we're giving in there, but that's when our load shedding started. So if we look at the strength of trade unions and what they do, it makes me very uneasy in this country because they bring the economy to a standstill. I think there's a lot of, as I say, they don't want to call it that way. I'll call it that way. I think sabotage happening around these things by trade unions. Their demands is ridiculous. It's unaffordable. It's way above inflation. And it will only push up inflation higher and push the economy into a further worse situation. But that's not something that we can do about. It's something that the government needs to do about that. So I don't have the answers as how to one stop it. I just know that it is a problem for the country, but I have no idea how to stop it because I'm not in a position to do anything. But I think we definitely need some government involvement. I know what I would do if I was in charge.
Yeah, sorry. And then one of the other things that came out is with SA that's in a growth wobble and increasing of interest rates, will it kill the South African economy on the spot? What's your views on that?
Just say again.
So South Africa is struggling with growth, and obviously with increasing interest rates, that puts a dampener on the economy. Will it kill the economy, South African economy on the spot? It's a question from Craig.
I don't think it will kill the economy on the spot. No, I think we have a slight advantage in the sense that even if the world goes into recession, or a lot of countries go into recession, we're still a commodity-rich country, and there will still be demand, and we're still strong on the export side. And I think our export market will carry us a little bit longer than what we think it will, and it will help us a little bit longer. And my opinion or my thinking is if there's countries going into recession, the oil price will decline. We will still export because there will still be some demand, but that will positively impact. If oil prices come down, it will positively impact on our terms of trade again. So no, I don't, and our exports will continue. So I don't think that South Africa is in that bad a position that it will impact or kill the economy immediately. I think we have other factors like the unions and what they do and wage increases that's more dangerous. And going into the end of the year, we're entering other uncertain factors in terms of what happens in our economy and what the impact of that could be. But in terms of the world picture, in terms of where we stand in our economic cycles and growth, I don't think it's in for an immediate kill, no.
So there's a lot of questions still coming through, but we just need to cut it short just to keep it in the time frame that's available to us. If you've got any other questions, you're more than welcome to pop us a mail afterwards, and we'll gladly be in contact with you to answer your questions directly. Finance guys, I just want to hand over to you to do the closing remarks. I just want to say, for now, we're definitely looking to host this again in the future, so please be on the lookout for when we're hosting it again. But I'm going to hand over to Finance guys just to do the closing remarks.
Yeah, thank you, Vichard. Thank you, Andre. And thanks, everyone, for attending and all the vibrant questions. It's great. Sorry we didn't get to all of them, but unfortunately, these gentlemen need to get back to the markets. That's why they can bring this to us, is because they're watching the markets closely all the time. So please look out for the recording, which will be going out in Ghost Mail. I would think TreasuryONE will send it out as well. It'll be on their YouTube, so check it out there. And thank you for attending this. This won't be the last one by any means. And to the TreasuryONE team, thank you. And we look forward to doing this with you again. And for those who are interested in finding out more about what TreasuryONE does, go check out the website. I've known these guys for a long time. It's a really great team. They do awesome stuff. And yeah, go have a look. They do more than you think as well. It's not just Forex.